Hey, good afternoon, everyone. My name is Bill Levinson, Managing Partner with Levinson and Associates. And with us today, we have Joseph Loughran, our Marketing Vice President. We also have a special guest speaker who we are delighted to have join us on today's call. He's also a friend of mine. That's Seth Groff, who is our Assurity Life Sales Manager on the life insurance side. And Seth is very, very sharp when it comes to designing products, or he's on the new product development team. In fact, he heads up that side. Very, very sharp and intelligent when it comes to field training our agents, and we're delighted to have him join us on today's call to talk about a brand new life insurance product that is currently not available in the industry today. So they just rolled out this product. It is awesome. It's got a great fit, simplified issue, guaranteed whole life product that is like no other. And I'm not going to steal any of his thunder. He's got a great presentation to share with our agents today. So we're very delighted to have him join us on today's call. We also have a white paper that we put together that talks about new insurance solutions that kind of, it was developed just for the younger generation, and kind of talks about how life insurance sales is today based on the new technology world and era, and kind of how you fit into 2015, 2016, and in the future. So this is complimentary to everybody that's on the call. We will send out an email with all brochures, any marketing material that is strictly based on this new product and new sales ideas based around this new whole life product. So great stuff to come. We're also giving away a free 16-gig tablet on today's call. That's going to the 100th registrant for today's training webinar. So we'll announce the winner in about 40 to 45 minutes. And then, of course, October is my birthday month, and we're excited that we are currently on the cover of Insurance Newsnet magazine. So we were asked to be interviewed for the cover story and article of the October issue of Insurance Newsnet. We couldn't be any more thrilled. In fact, we're going to show a quick slide and screenshot of the article, and then we'll include that in today's email after the call. So all participants will get to see the article, and then, of course, all marketing material based on today's training. So Joe's going to talk about our upcoming training webinars, which is what you're on right now. Just keep in mind, we don't just have a weekly webinar to take up time and say, hey, Levinson is hosting another webinar. We try to go out there and dissect and sift through all the latest carriers and products and technology tools and platforms, and we handpick anything that we think will help our producers separate themselves from the competition. In other words, we're out there every day looking for what's ever hot or what's not, and whatever we think is worth spending 40 to 45 minutes on a training call with our agents, we simply pick and we bring in a guest speaker, or me and Joe, of course, dissect that product or carrier and bring it to our field force. So we would never waste 2 minutes of your time with something that we don't think is worth your while. So that is exactly what today's webinar is about, a hot product that is going to separate you from the competition. Joe's going to talk about the upcoming training webinars, and then we're going to dive into the presentation. Joe?
Thanks, Bill. Of course, I do want to actually cover some upcoming training webinars for next week, like Bill mentioned. You can actually go to kerrylevinson.com to register for any one of these upcoming training sessions. You can actually click on the training calendar and see all the webinars for about 4 to 5 months out, so you can get a good gauge of what's happening, what's going on in the industry. Of course, Tuesday of next week, which is the 13th at 11 a.m., we're actually going to be co-hosting a webinar with Principal Life to talk about their new Provider Edge UL product. That's one of their products that you can actually get approved up to $1 million of coverage with their accelerated underwriting program. And then Thursday, which is the 15th at 2 p.m. Eastern, this is going to be a great call we're actually having Amanda Marquez, who is our internal in-house underwriter, on the phone. We're going to be covering the Levinson Impaired Risk Division, all the advantages to working with Amanda and what we can do from an underwriting standpoint. We have actually had some really, really great examples where we've taken a decline case or a highly rated case and got a very, very strong, good offer on that case and really helped all those agents that had decline cases turn those declines into new commissions. So that's the focus of that webinar. Again, that's at 2 p.m. on the 15th. And then on the 20th, which is the following week on Tuesday at 11 a.m. Eastern, we're covering Index Universal Life sales concepts, specifically the smart money concept. We're going to be showing all the agents on the call some different client videos, some consumer material, and really give you a good idea of how to position that IUL product, how to actually generate more leads and more sales using that IUL smart money sales concept. Of course, you can actually check out our YouTube channel. We've got over 100 videos on demand, anything from new product rollouts to our free agent websites, to even some information about our upcoming annual Agent Expo, which is actually at the bottom of the screen. We actually did schedule the 2016 Expo for April 8th, 2016. This is basically a day full of sales concepts, full of sales ideas. We start very early on in the morning. We provide breakfast. We provide lunch for all agents that attend. It is absolutely free to attend, but the neat thing about this actual seminar is that based on your production levels, you can actually qualify for a free night stay at that beachfront location, as you can see from the picture. And then depending on where you are in the country, you can actually qualify for round-trip airfare. The neatest thing about what we do at that event is not only cover sales ideas and concepts and what's going on in the industry, but give you actual ideas and concepts to generate new business. Of course, all production qualifies: life insurance, annuity, long-term care, even disability, critical illness. Every single one of those products that we offer qualify towards that production credit at the expo. So definitely take a look, visit the home page. You can register right on CarrieLevinson.com.
Okay, thanks, Joe. So what's new with Levinson and Associates in the fourth quarter and then moving into 2016? So as you know, we never just sit back and rest on our laurels and say, you know what we've been doing for the past few years is totally different, unique. It really sets us apart. We're growing in production every year, so we're going to sit back and relax. We take just the opposite approach. We say, you know what, we're growing, things are great, what's next, okay? As I always say, you have to constantly wear two hats. One is pointing straight, saying, you know what, I need to conduct my day-to-day business and make sure I'm doing a great job in servicing our agents. The second one is always pointing to the left or north, saying what's coming next. We have to be one step ahead of the competition and building new platforms, rolling out new products constantly. And you, as an agent, need to say the same exact thing. You need to say, you know what, my day-to-day business is going great, but we need to constantly grow and change and pivot in order to make our business bigger and better tomorrow. So with that said, we have a brand new platform that we put together called the Levinson Agency Automator. This is kind of like a CRM tool on steroids, if you will. It's going to do all of your automated marketing for you. Of course, it's going to send out your email blasts. It's also going to have a built-in lead capture. It's going to track visitors that go to your website. It's going to do what we call customized touch marketing. So I'll just give you a quick example without getting into too much detail. So let's say you have your lightning issue term link that's up on your website, okay, and you have clients that run a quote on your link, okay, but they never move to the second part, which is filling out the application. So what the system does automatically, it sends those clients an email and says, hey, you ran a term quote on my website, and I saw you didn't fill out the application. If you have any questions or maybe you have a health issue, well, these are guaranteed issue products that will work that don't have any health questions. And then it gives them sample rates, and if they don't respond to that, then they get a follow-up email 2 or 3 weeks later that says, hey, we sent out this email, you never responded. So it just kind of does all the marketing behind the scenes for you on autopilot and keeps track of everything literally with the click of a button, so you can track all of your marketing efforts. So this is really, really neat. It's called the Levinson Agency Automator, and it's very easy to use. We made it very user-friendly. We have instructional videos. We have live support 24/7. So anyway, you're going to see that rolling out in November. So great stuff to come. We also have the Lightning Issue Term product, but is level guaranteed option. Okay, so when your clients go in to run a quote, they'll have an option of picking the decreasing mortgage term or level guaranteed term, and the premiums are just about as competitive as like a typical Banner Life fully underwritten term product that takes 4 to 6 weeks of turnaround time, when our product has an instant approval. So you're going to see the level Lightning term product rolling out January of 2016, just a few months away. And then last but not least, we have our college scholarship platform with a new, very easy to enroll process. So as soon as you sell a product that qualifies for our scholarship platform, all you do is send the client an email. They self-enroll. It takes about 2 to 3 minutes for the entire process. So there's no more hurdles. You don't have to get your arms wrapped around anything. If you have a client that qualified by buying one of our qualifying products, you send the client an email. They fill out basic information, name, address, policy info, hit submit, and you are done. You just enrolled your client in our Sage Scholarship platform. Best part is most of the Assurity Life products qualify for the scholarship platform, including the brand new product that you're going to learn about today. So we couldn't be any more excited. These are some scholarship updates that are just in. As you can see, our program is growing every year. Okay, class of 2015 statistics, we submitted, as you can see there, 45, excuse me there, 40, and I think, Joe, is the number right there? It's 45,125?
Yep, just over 45 million in scholarship rewards.
Okay, that is huge. That's about 30 to 40% higher than the year before. So we're constantly growing the program, and we're adding, on the average, of 2 to 3 colleges per month. We now have 344 colleges in 45 states across the country. Okay, so that means I don't care what city or state the client is in, we will find a college that will suit that student or child. Okay, and even if little Johnny doesn't use the scholarship program, his sister Lisa might. And if Lisa doesn't, you can transfer the program to an unborn child or any other blood relative. And the program doesn't cost them anything anyway. So the point is, it's a no-brainer, and it comes completely free with any qualifying product. And right now, we have almost 10 carriers, over 50 products to choose from. So as you can see, the program works. This is the #1 differentiator to set you apart from your competition. As you can see, we have all of that marketing material available here in our office, so we can mail you or email you any marketing material that you want. Plus, we have the new Professor 101 series that teaches you all about college planning, college education, so you know the terms and lingo and FAFSA programs and what 403B is, and basically everything you need to know so you sound like a college planning professional, all at your fingertips, all free. So let us know if you're interested, and we will get that sent out to you as soon as possible. Joe's going to touch on that new client self-enrollment system, so there's no more hurdles to get over. Everything is black and white, very simple to understand. Joe?
Yeah, thanks, Bill. So we updated the whole way that the scholarship platform was working. There was a couple extra steps that we eliminated, which makes it very, very simple, very easy for your clients to actually sign up. So even by just having a quick conversation with the client about the scholarship platform, you can actually send them this link, and they can actually put in your unique Sage Agent ID, which will, of course, tie them back to your account. That client can then self-register. The best part is you now have access to all that information. So not only are you helping clients, you're making it very simple, very easy but you're also capturing all that client information. So now you can follow up with them, use the agency automator system that we put together, and then drip market on that client, or just follow up and say, hey, I see you added 3 students here. You're actually underinsured. We should talk about some other options. So very simple, very easy way to actually maintain that scholarship platform. And of course, once that client purchases an eligible product, all the ongoing reward points are automatically inputted into their system. So there's no ongoing work. Everything is done behind the scenes, which of course gives you more time to talk to more people, prospect, and actually generate more leads. So just a great improvement to an already great program.
Okay, thank you, Joe. Yeah, and keep in mind, we are the only IMO or agency in the country that has the SAGE scholarship program with our qualifying products. So you don't have to worry that another agent down the street is pitching or selling the same thing to your clients. Okay, and I'll just use this quick example, and then we're going to introduce Seth. But if Joe is a life insurance agent, I'm a life insurance agent, we're both pitching a similar product to the same client. Okay, if Joe is pitching a 20-year term with return of premium, and I'm pitching the same product, say with Assurity, okay, or Kansas City Life, whatever the carrier is, our premiums are neck and neck. Even if the client likes Joe a little bit more, they're going to go with me every time because I'm giving this 1 free year scholarship, okay, that they can use for little Johnny or little Susie that has a $40,000 value, and they're not paying any more premium for my program. So they're going to work with me every single time. So you should be thinking the same way. Even if that client or family, let's say they don't have any children right now, they can start to stack up points and then transfer the account to an unborn child. So the value is there. Even if the client said, well, my kid's going to Florida State, okay, and Florida State's not on your list of colleges. Well, that's okay, because if Johnny wants to go to Florida State, little Susie is going to be going to college in a couple years, and she might want to use the program to one of our 344 colleges. And if she doesn't, you can transfer it to any blood relative, cousin, niece, nephew, and you didn't pay for it anyway. You're not paying any extra, and the agent is not taking a commission reduction. So it's simply a no-brainer. I hope everyone understands why we get so excited about this. So without further ado, I'm going to introduce my friend and life sales manager at Assurity Life, Seth Groff, who's going to dive into a brand new product for the industry. Seth, you there?
I am, and thanks, Bill. And man, you guys got a lot of exciting stuff going on there over at Levinson's and Associates. So that was all great to see, and you guys provide a lot of value to the agents that work with your organization. So with that being said, I am going to dive into Assurity's new joint whole life first to die product, and I'm really excited about this product. It actually just rolled out exactly today, a week ago, and all the feedback that we've received has really been positive. And really what I want to accomplish today is basically 3 things. 1, I want you to have a better understanding of why Assurity decided to roll this product out. I got to jump into the nuts and bolts of the product just a little bit because I want to make sure you understand how the product is going to work, because it is different than the products that you're probably used to selling. And then finally, the 3rd thing that I'm going to talk about is really look at 2 markets and show you how you can solve a problem in two specific markets. So that's what I'm going to cover today. But why you, the agent, should be excited is because this will allow you to have a different story to tell. I'm not saying that the problems that this product solves are new. We've seen an increase in these specific problems over the recently, but this is a new solution, so it's giving you a new story to tell, a new solution, and it's really going to give you an edge over your competition. So that's what we're going to cover today, and I'll go ahead and get started. But first, before I get into that, real quickly, I want you to think about name that year, okay? So Jonas Salk invented the polio vaccine, and it was widely accepted. Gunsmoke first debuted, and Disneyland opened its doors in California. Now, obviously, we're on a webinar, so you can't answer the question, but just go ahead and think. Was it 1955, 1960 or 1965? And if you answered that question as 1955, you are correct. Now, you might be asking, okay, Seth, what does that have to do with today's presentation? Well, what I'm going to show you here in a few slides is how life insurance was sold in 1955. Okay, I'm going to take a step back in time. I'm going to show you how life insurance was sold in 1955. Then I'm going to show you what's changed since 1955 and why a first to die joint whole life product is the product for today's generations and today's marketplace. So that's what I'm going to do. But before that, just remember, if you're not familiar with Assurity, remember we're a mutual company that say that we work with middle income families. And you know, there's all kinds of demographics out there about what middle income families you know, what the income ranges and things of that nature. The biggest thing you just have to remember is how I define middle income families are individuals that get up and go earn a living to maintain their current lifestyle. Okay, so the lifestyle that they've established for their family, in order to maintain it, they need to get up and go to work. And if you think of that demographic, you know, that accounts for most of the population out there. That's really what how we design our products, and I'll tie that back into how First to Die Joint Whole Life actually targets that demographic of the individuals that go up and work to maintain their current lifestyle for their family. So with that, before we get into selling life insurance in 1955, this is very important. You need to have a firm understanding of what a joint whole life first to die product is. Okay, what we're going to do is we are going to insure 2 lives on 1 policy, and we're going to pay the death benefit in the event of the first person's death. Okay, so 2 lives, death benefit in the event of the first person's death. And obviously this is going to be a less expensive alternative than 2 standalone policies, which I'll talk about the discounts here in a few more slides. But remember, 2 lives, 1 death benefit in the event first person's death. That's important to grasp the concepts that I'm going to talk about here in a few slides. A question that keeps coming up is, why did Assurity put this on a participating whole life chassis? And the answer to that is that with Assurity being a mutual company, one of the product lines that we're really working hard to grow here at Assurity is our participating whole life plans. Because being a mutual company, we have a very powerful story to tell, long history of paying dividends, and we already have some great participating whole life policies with our individual standalone policy, our single premium policy. This just completed or kind of rounded out the portfolio. And so that's really, from a company standpoint, we're trying to grow this market, and this just allows us to accomplish that. So now, jump back to 1955. This is how life insurance was sold back in 1955. This is an actual brochure that was used in 1955 from Assurity agents that we gave to Agent Force to sell life insurance. And as you can see, it says, with you in the picture, your home is protected. Now, obviously, in 1955, who was this targeted towards? When the agent went out there to meet with this family, he was targeting the male, right? Because in 1955, he was probably the primary breadwinner. The wife stayed home and took care of the kids. Even if this happens, your home is protected, right? The man knew that he needs to protect his home in case of fire, so he purchased homeowner's insurance. But suppose this happens. So now the male's out of the picture. What's going to happen to the family? If your widow cannot pay off the mortgage, she will lose her home. And where could she find another place to live, right? Now she's packed up, has her suitcase. You can see the movers are there. She has to leave the nice suburbs. Where is she going to go? Oh, wow, look at this. She ends up in the slums. So what kind of home could she afford on the income she will have? If your widow can pay off the mortgage, she has a home if she wants to keep it, an asset if she wants to sell it, and income if she wants to rent it. A debt-free home is equal to a rent check every month for life. When she has no rent to pay, Social Security or a small amount of life insurance income will take care of her living expenses. Mortgage cancellation insurance puts a match to your mortgage. It provides cash for one of the finest gifts a man can leave his family, a home free and clear. Now, the reason that I want to show you this is because clearly this is what I call the Leave It to Beaver type sell. And this is how life insurance was sold back in 1955, whether you like it or not. The life insurance agent went out there, he spoke to the male, he wrote the life insurance on the male because he was the main breadwinner, maybe a little bit on the spouse, and he went on his way. But what Assurity realized is that there's been a shift in that type of household. No longer is it just that families are relying on only one income to support it. Now you're seeing an increase in what we call dual income families, where now they establish a lifestyle based on both their incomes, both the husband and the wife's income. And as a result, it's no longer enough to go out and only write life insurance on one of the individuals, because now not only have the incomes leveled out, but in some cases they've even flip-flopped. And so we need to make sure that we're protecting against premature deaths of both spouses, and a joint whole life first to die is going to be a more cost-effective way to accomplish that than writing two standalone policies. So that's why we developed it. This product is because we saw an increase in dual income families, and we needed an affordable solution to protect against the risk of either of the spouses' premature death. Another thing that we realized is that we saw an increase in dual income families with no kids, right? The dinks. And what we realized is that a lot of couples are waiting longer to get married, and then they're also waiting longer to have kids, and in some scenarios deciding not to have children. Now, I'm not saying this product doesn't work. If you do have kids, it does. Just one of the reasons that we got excited about this particular market is because this demographic actually typically has more disposable income, because let's face it, right? Kids can be expensive. So if we position it correctly and we show them the value of permanent life insurance, here's going to be a more cost-effective way to protect against either of their death. Another change in the demographics that we noticed was all these baby boomers, right? All these baby boomers are reaching retirement every day, and what we realize is that for whatever reason, right or wrong, a lot of this demographics, they haven't taken the necessary steps to completely self-fund their retirement, right? And so they're going to have to rely on Social Security to help supplement their retirement. Now, if both spouses are earning an income, or excuse me, if both spouses are receiving a Social Security check, in the event of either of their death, the surviving spouse gets to keep the higher of the two Social Security benefits, but they do not get to keep both of them. So automatically that creates an economic loss in the household. And that's not a temporary problem. That's not if that happens. That's a question of when that happens. And since it's a when that happens, we need a permanent solution. We can't solve that problem with term insurance. We have to solve that with a permanent product. And as a result, a joint whole life first to die product is going to allow you to solve that in the most cost-effective manner. So that's the opportunities that we saw, the increase in dual income families, and then also this fact that all these baby boomers are going to be receiving Social Security, and that's going to be the case studies that we're going to focus on today. With that being said, just a couple of quick nuts and bolts about the product, because I need to make sure that you understand this. The first thing that you have to keep in mind is that this is a first to die product. And why I point that out is that we need to make sure that both insureds are going to be insurable, okay? So since we're protecting against the highest risk, right, the likelihood of the first person to die, both insureds need to be insurable. And so the way that works is we actually underwrite each of them on an individual basis, and after we underwrite them on an individual basis, then we determine our joint underwriting class, okay? So if they both come back preferred or preferred plus, they would get the preferred joint rate class. If one was preferred and one was standard, they would get a standard rate class. Both tobacco, they'd get the tobacco rate class, and if one was tobacco, one was non-tobacco, they'd get the combination class. But be aware that we underwrite each of them individually and then determine their joint underwriting class. Also, keep in mind that there is going to be a joint issue age, okay? This is what creates the discount in the product. And basically what we do based on their actual age, we determine what the joint age is. The good news is you don't need to know how to calculate this. Actually, the illustration software will automatically calculate this. You just enter in their actual age, and then the software calculates it for you. So you don't have to worry about it. The only thing you need to be aware of is that on the actual illustration, and when you look at the ledger, it's actually always going to refer to the joint age, okay? So when you're talking to a couple, there's going to be a joint age, and if they're like, hey, I'm 60, or I'm 40, and my wife's 38, why does it say a joint age of 39? Well, that's the reason, is because we look at that joint age. Otherwise, the other thing that I want to point out, and Bill did touch on this a little bit, this product does have non-medical limits built into it, okay? And so when you look up there at those premium bands, if they're applying for a joint whole life policy and that base amount is under $149,999, it's going to be underwritten on a non-medical basis. If they're or it's going to be underwritten on a non-medical basis. So what does that mean? It's still a traditional life application, okay? So they still have to answer the typical questions on a life application, but they're not going to have to do the paramed, blood, and urine. And the reason for that is because the way that it was actually better for us to not require to do those, because then we didn't have those costs built in. So all the way up to $150,000, they wouldn't have to do a paramed, blood, and urine. Still fully underwritten, still have to answer the health questions. You know, we're going to do our typical checks with the MIB script, motor vehicle, possible APS, but keep that in mind that up to that point, $150,000, they wouldn't have to do paramed, blood, or urine. Now, if they're 61 and above, that does drop to $74,999, but still a very high limit as to what would not require them to do those additional underwriting requirements. So, you know, convenience plays a huge factor in getting life insurance issued in this demographic, middle-income families. And here it's just built in the policy, built in the process, so we can give them that convenience factor when they're applying for it. Other than that, you know, the basics of the products, they all mirror our standalone individual product. So, you know, all the dividend options are going to be the same. So like your internal rate of return on the cash value growth is going to be very comparable to the individual product. Same commission that you receive on the individual product for this. MOLO factors, policy loans, all that is going to be the same. So everything else pretty much mirrored the standalone product. We do have some riders available on it. You know, the children's term rider, this is a great starter pack for a family with kids, because now you insure both spouses, and now you can throw an inexpensive way on there to cover their children as well. The joint disability waiver, the thing that I like about this waiver is that it covers both of them, and if either of them become disabled, then we waive the entire premium. So it's not that both of them have to become disabled, or that if one becomes disabled, we only waive 50%. If either of them become disabled, we waive the entire premium, which is pretty cool, and I think it has a lot of play in the business market, because this can also be sold as a buy-sell agreement. I think there's a lot of play there, and that's really going to appeal to that business market as well. Joint level term rider, you know, I mentioned this earlier, you know, one of the objections we get to permanent life insurance is that it's too expensive, right? Well, joint whole life automatically addresses that, because we're going to be able to get these policies, you know, 25 to 35% less expensive than two policies. So we're already kind of addressing that too expensive objection. But what the level term rider does is allows you to even address it further and make it even more affordable, because now we can look at what their total death benefit need is, or life insurance need, and now we can do that perm term blend to even get the cost lower. So it's even making it more affordable for people that are going to be premium conscious by doing that term rider that's, you know, convertible, and it's just going to lower the cost in a 10 or 20-year term. Other than that, we do have the paid up additions rider if you want to do some cash accumulation or enhance the cash accumulation, and then the accelerated rider, you know, we can accelerate up to $250,000 if you're terminally ill or permanently confined to a nursing home. So some great benefits there. Now I'm going to address the questions that always come up in the presentation. This is kind of the question that always comes up. What if the couple gets a divorce? Or what if you write this in a business setting for a buy-sell agreement and then the business dissolves? Well, we took this into consideration, and it's a great question. And when we were looking at different solutions, what I wanted was one that was easy to understand, one that was easy to implement, and then also was fair to both the insureds and both the policy owners. And what we determined and what we decided to do was, in the event of a divorce or a business dissolution, they have the option to split the policy. So maybe the divorce decree says that the policy stays in force. That's fine. They have that option. But maybe they say, you know what, we don't need this anymore. We don't want this anymore. We want to split it up. What are our options? Basically what we do is we surrender the policy, and we split the cash value 50-50 between both policy owners. So typically when this policy is issued, both insureds are going to be the policy owners unless otherwise specified. So assuming that it's like that, we're going to split the cash 50-50, but each of the insureds have the option to get up to 50% of the original death benefit without proving insurability. So basically they have the option to start a new policy if they still have a life insurance need. So we're still protecting that insurability. We split the cash. It's the fairest way. And, you know, really when I make this joke, I say it's easier than splitting up a cell phone contract, right? And it's fair. So that's how we handle it, whether it's a divorce or whether it's a business dissolve. So either situation, split the cash. You can get 50% of the death benefit without proving insurability, which is huge. The other question that comes up quite a bit is that, well, yeah, it's less expensive than 2 policies, but you only get 1 death benefit, and that's a fair question as well. But what we did here is that we decided that we are going to give the surviving spouse an option to decide if they want to start a new policy in the event of the first person's death. So when the first person dies, the death benefit's paid out, right? And then that surviving insured gets to make a decision at that time if they want to have their own individual policy. Because really the loss happens in the event of the first person's death. The surviving spouse might not need as much life insurance. Maybe they do, but then they can start a policy at that time. Just keep in mind that it is at attained age, and then the other caveat in there that you do need to be aware of is that that has to happen before the age of 74. So at 75, that option's not available, but in the event of a premature death, that individual would have the option to start their own policy if they decide they need one, or a policy of a lesser face amount without proving insurability. So that's huge as well. Also, this question comes up, what if the couple dies simultaneously, like in a car wreck, right? And the answer is we actually double that benefit. So if they die in an accident simultaneously within 24 hours, we're going to pay twice the death benefit. So if they have $100,000, we'll pay $200,000. You know, then we always get the morbid question, well, what if one's on life support? Well, that's not that big of a deal, because remember, we have the surviving spouse benefit. So I always told people, keep them alive, execute the surviving spouse benefit, and then you're still going to receive that double death benefit anyways. So those are the questions about the products that come up quite a bit. And now really what I want to talk about are the markets and how to sell. Keep in mind, this product is designed for the 99% of American families, okay? This is designed for the people that their household really is going to suffer the economic loss in the event of the first person's death, right? The 1% of the population, the economic loss happens in the event of the second person's death, because then that's when you start getting into estate taxes, things of that nature, and that's when you use a second to die policy, right? But for most families that work to maintain their lifestyle, that economic loss happens in the event of the first person's death. And so as a result, a first to die really is for the 99% of American families that work to maintain their current lifestyle. So really what we're looking at here for the primary markets, any 2 people that rely on 2 incomes, okay? So think about this. If you and your spouse both work, you're a great prospect for a joint whole life policy. But today what we're going to focus on are 2 with the dual income, no kids, the dinks, and then replacing Social Security. And then in the future, what I'm working on now is some different concepts for the business market, the buy-sell market, because this market has really generated some interest, and this has been some big premiums that have been quoted to address this. So we had to pick, I can't cover everything obviously in a short webinar, so keep in touch with Levinson, and hopefully we'll be able to do a presentation in the near future to cover the business market. So real quick, dual income, no kids, how is it going to be sold? Remember, couples are waiting longer to have kids, decide not to have children, and this demographic is more likely to have disposable income. The real risk here is that they've created a lifestyle based on 2 incomes. What I mean by that is that when this family or when this couple went in to purchase a home, to purchase a mortgage, they didn't go in there and say, well, we're both working now, but maybe in the future only one of us will be working. That didn't happen. They bought a house based on both their incomes, okay? And so the debt is what really creates a problem. Replacing income might be a secondary concern, but really what their biggest issue is the debt issue. So we got Cindy, age 30, making $65,000. Kevin, age 27, making $45,000, both healthy. And when we look at their debt picture, you can see that they bought a $175,000 mortgage. They're paying some student loans off, and they also went out and bought a new car, okay? So when we look at their total debt picture and we add up their monthly payment, basically their debt payment to pay off their debt is $1,700 a month, okay? That's what they have. When they're both working, because this couple was pretty well off, right? They were making $110,000, pretty good for a young couple. If you assume a 25% tax bracket, their take-home pay is $6,800, right? So basically 25% of their take-home pay is going to pay off the debt. Life is good, right? The bank's happy. They're happy because they have a lot of disposable income. So everybody's happy. Life is good. But where the problem happens is that if Cindy dies, remember Kevin had the less of the two incomes, so now 61% of his take-home pay is going to pay debt. The bank's not going to like that. Kevin's not going to like that because he's not going to have any disposable income. Everything's going to basically pay off debt. That's a bad situation. And the same is true if Kevin dies. Cindy's going to be up in a better situation because she has a little bit higher income, but still 42% of her take-home pay is going to pay that off. Now, in most situations, an agent that would come across this, the agent is going to sell term insurance, right? They say, well, they have $227,000 debt, they're young, term insurance is inexpensive, they go out, they write term insurance on both of them, it's $650 a year. But you have to change your mindset, and you have to educate your clients on the benefit of whole life insurance and why they should consider a permanent solution. And what I show this couple is that, yeah, it's only $650 a year, but over the course of 30 years, their out-of-pocket is $19,410. And that money is gone. They have the protection, which they need, okay? But nobody likes paying for term insurance because they say at the end of 30 years, it's gone. I've paid all these premiums, never used it. You don't like it, right? Well, what we can show them is that with the joint whole life policy, the annual premium is going to be more. In fact, it's going to be 5 times more because it's $3,100 a year. But what I show them is that over the course of 30 years, they pay $93,000. But look at that cash value growth. That cash value growth over that same 30 years has grown to $126,000. And so now, instead of having a loss with paying for that life insurance, now we have a $32,000 gain because of the increase in cash value. And so instead of having a debit or a negative value in your balance sheet over the course of 30 years, we're actually creating a positive growth, a gain in your personal balance sheet. And that's what you have to educate them. And that's why I think there's such an opportunity with this dual income, no kids, because they have the disposable income to pay for it and then have that situation where they're not just losing the premiums, they're actually getting that cash value growth. And so that's what you have to educate them on with that product. With that being said, you know, the alternative to it is buying 2 standalone policies. As you can see, if we did 2 standalone policies, it'd be $4,500 a month. So we just created a 31% savings by going the joint whole life versus 2 standalone whole life policies. And if 31% doesn't get you excited, look at it like this. If that's a $1,500 a year savings, take $1,500 a year times 30 years, now you're talking about some significant savings. Other than that, real quick, the next case study, I'll go through this quickly, is on Social Security. Remember, we mentioned this earlier, that a lot of people are waiting or are going to have to rely on Social Security to help supplement their retirement. And then remember that if they're receiving 2 Social Security checks, in the event of either of the spouse's death, they only get to keep one of the benefits. They get to keep the higher of the 2, and that creates an economic loss. Life insurance can help reduce that household impact. The biggest thing that you have to realize by going out and selling this concept is you really need to be targeting people ages 50 to 60, okay? And the reason for that is because when you get 65 and above, your cost savings, well, not that your cost savings isn't there, it's just life insurance gets expensive when you get 65 and older. And so for this demographic that's going to rely on it, we have to do it early when they're working so that they can afford it, and it's just a small portion of their income. So remember, with this concept, we're targeting people 50 to 60. Not that it can't be done 65 and above, it's just the cost of permanent life insurance and having enough to cover replacing Social Security, it just gets expensive. And, you know, maybe now it's 65 and above, you're just writing a joint whole life policy for, you know, final needs or something like that. So remember that. But in this example, they're going to retire in the same year. So they plan on retiring when John's 67, Linda's 65, and you can see what their projected Social Security benefits are going to be in those given years. So really what we have to protect against if we replace that Social Security income for 5 years, and remember, we only need to protect against the $18,815 because the surviving spouse gets to keep the higher of the two. So if we look at that, if you take $18,815 times 5, that's $94,075. But we assume we get the life insurance proceeds, can invest it, and so if we take it out, you know, $18,815 a year, basically what we need is $88,000 of life insurance. And so if we look at $88,000 life insurance, you know, this is a permanent problem. We need a permanent solution. If we go with the joint whole life first to die, that's going to be $3,500. If we go 2 separate standalone policies, that's going to be $5,400. So now we're creating a 34% savings on joint whole life, and that's only going to be 3% of their current income. And so that's what I'm pointing out of why you need to be targeting that 50 to 60, because it's such a smaller percentage of their current income. And then at 65, now we can decide what we want to do. Maybe we want to continue to pay it. Maybe we want to execute a reduced paid up. Maybe we want to use the dividends to pay a portion of it. We can make that decision at that time, but it's really going to be the most beneficial if we target individuals that are 50 to 60. So with that, you know, starting the conversation, I know I'm pushing up on my time, so I'm not going to spend much with this. Just remember, it's not joint whole life. You just have to be able to tell the permanent life insurance story, okay? That's the key to it. And then joint whole life is going to be a more affordable solution than going 2 separate policies. And remember that we have those factors or those tools built into it where we can actually get our second death benefit as well. So with that, Joe, Bill, I don't know if you're still on the line. I'll open it up to any questions if you have it. But that's what we have. That's how people are selling it, and that's, you know, what we're excited about.
Yep, Seth, great job. That was awesome. Great presentation. In fact, me and Joe were on. The line is actually closed because of the number of attendees.